Hello, everybody. Welcome to Friday, another Talk Money with Tom show. We're back. Actually, we were supposed to be here last Friday. We had an equipment failure. The mixing board that does our audio just decided not to work. So now we have two of them. We got a backup for next time, so we're ready for that. But this show's about answering questions, and so one of the things you can do if you'd like, even during the show, is send in your questions. We'll try to answer those live. You can do that two ways. The email address you can see here on the screen. Ask Tom at talkmoneywithtom.com, or you can put it in the chat if you're signed in here on the YouTube channel, and we'll try to answer those. You can send in those questions also during the week if you want. We do get those coming in, and we can try to get a more organized answer for those also. Of course, we have this channel for a reason. We feel like education around the concepts of retirement. The big three things we try to cover are, asset management, what to do in terms of your retirement planning, and then tax planning, especially during retirement. Now, whether you're retired already or looking forward to retirement, a lot of these concepts are something that are really, I think, important to learn to make your retirement work better, at least financially, as far as that goes. And then, of course, if you have some questions you just want to ask us personally, you can do that by booking an appointment with Easton and I. Our schedule is live on the website. You can see the link to our website here on this page. Up in the corner is a button, looks just like that. And click that button and you can pick a 30-minute time to talk to Easton and I, phone, video, in person here in the office, whatever works for you. Anyway, so that's what we're looking forward to today. So again, I think, the beginning of each one of these shows, I like to talk about kind of what I saw happening in the market this week. And I'll cover a little bit of the last 2 weeks in a way, just because, we didn't have this summary last week. But so let me switch over so we can see what's going on. Okay, so there's some significant things that are happening here. We've been looking at this chart for quite some time as it's been kind of building as far as that goes. But this is the first time, and I'm going to zero in here a little bit, zoom in a little bit here. This is all weekly data going back to 2018, just so we can see the whole thing, the pandemic, the run up, the downturn in 2022, and et cetera. But if we look at what's happening here, so this is the last 12 months now, just looking at it in daily data. And so I draw a line there because this is the first time since October 13th of 2022, when we hit the bottom of that downturn, that we've had a lower low. Okay, so Charles Dow, who's actually the founder of the Wall Street Journal, and eventually became, all of his writings became what's called Dow theory. And part of Dow theory is that what's called the primary direction versus the secondary direction. So one component of that is that when you're going up, you have higher lows. So if you look at this daily chart, this is just the last 12 months. Look at how many times the market has fallen. It's still higher than it was 12 months ago, that's for sure. But every single one of those lows has been higher than the low prior, right? This week is the first time we kind of set a new lower low. All right, so it's the beginning of kind of the checklist. The other big thing that I look at, and we have others, I'll keep this kind of simple, but is the 50-day moving average versus the 200-day moving average. So again, this is the same 12-month look, last 12 months with the daily data. The orange or gold or what have you line is the 50-day moving average. So every point on that line is an average of the 50 previous days, right? And so then the blue line there is actually the 200-day moving average. And what you want to watch for there is when it crosses down. Okay, when the 50 crosses down through the 200-day moving average, and you can see it's heading down.
Yeah,
right?
you get your death cross and your golden crosses.
Yeah, death cross is when it's coming down from above and crosses down through. And so that's theoretically a sell signal. I'll show you some examples of that here in a minute. And then the golden cross is when it comes the other way, when it comes from underneath and comes up through. Okay, so we're a ways from that, to be honest. And it is interesting today. We're getting a bounce right off of the 200-day moving average. These things are watched very heavily, and used in trading systems and what have you. I haven't found, just pure crossover strategy. So, buying and selling based on when it crosses over the 50-day or 200-day moving average. We've back tested that to death. It hasn't been very successful. In my opinion. You can do all kinds of things. You can, when the 50-day starts to turn down, that's a signal. We've not been able to make that work. The 200-day moving average moving down actually has some predictive abilities as far as that goes. That's still going up as we speak right now. So we'll see what happens there. But the way that you want to look at this, and I'll show you. Okay, so this is an example. Here's the 2008 downturn. All right, so again, looking by the day here on this particular chart, kind of a 3-year run. You can see back in 2007, we had a death cross, right? The
Yep.
50s moving down. So you would have gotten more conservative or gotten out or whatever. I'll talk about what we do here in a minute. And then gotten back in when that golden cross came in. It's a pretty good trade. It's a pretty good time frame to sit out as far as that goes. The problem is, and I'm going to use kind of an interesting one here, here's the 2018 tariff downturn. So this is when they first started doing tariffs at the very end of 2018. The market dropped 19.6%. You can kind of see that. The bottom there was actually the day before Christmas, which was no fun. But you can see that the signal there, you would have actually gotten out at and back in at a higher point, right? So here's what you want to think about with this type of crossovers. It works best when there is a systematic issue that's happening, right? So if you look at the 2008, I'll go back. So 2008, prior to that, we are issuing mortgages like mad. I mean, just flooding the market with mortgages. Anybody who applied pretty much could get a mortgage for any purpose. And one of the reasons was they were taking these mortgages and putting them together in a bundle and putting it in a bond and selling them internationally. They were AAA rated supposedly because mortgages as a group, if you have 1,000 mortgages in a bond, you're probably not going to have that much, in the way of defaults. And they were regionally diversified. And so it was thought at the time that, this really it can't happen. We can't have a big mortgage, And so then in infinite wisdom, a bunch of companies decided, well, these are so safe, they're AAA rated, we're going to put insurance policies on those bonds. And so you could buy an insurance policy. It was called a credit default swap. And they sold $7 trillion worth of credit default swaps in 5 years. And so once the mortgages started to fail in large numbers, these companies had to pay these insurance policies off. And they sold everything to do that. It didn't matter, So there was no diversification in 2008. Gold went down. I mean, bonds went down. Great stocks went down. I mean, everything. And then the last big drop-off that you see there, that cliff, was actually where Lehman Brothers finally failed. And then we had another 30% drop. We were down 20-something%, and then all of a sudden we ended up down 57% in total. And so that's systematic. I tell you that story because those are things that are they're like fundamental. You can't just change your mind and do something to change the market. So when you look at the tariff piece here, and this is an important point, I think this is really important. Two things were happening. Number one, they were putting up tariffs, right? Mm-hmm. And the market didn't like it. Still doesn't like it, but didn't like it back then. Was worried about what it would mean. And then secondly, the Federal Reserve was also raising rates at the same time. So two decisions were made. Number one, they stopped doing tariffs. Number two, they stopped raising rates, and eventually actually started lowering rates. And the market actually did quite well all the way through 2019. It was still running quite well right before the pandemic, in kind of February of 2020. And so that's something to really understand about what's happening right now. Okay, we do not have a systematic, fundamental issue. Some things are slowing down. Some consumer surveys, people are concerned. The gross domestic product will probably start to deteriorate from where it was, last year. But we don't have, a real downturn like we saw in 2008.
Yep.
All right. What we have is somebody deciding whether they want to do tariffs or not. Okay. And so if they change their mind, market could go right back up. And unfortunately, they've been changing their mind almost daily. And it's like today there was some more commentary about more tariffs, on a Fox News interview, and it was an interesting interview, but nonetheless, that's something to think about. So these crossovers that we're talking about here aren't probably that effective unless you have some fundamental issues that are really driving down the economy, and really, creating, higher unemployment and all those types of things. So what we do is we don't use the crossovers as a wholesale mechanism to get in or out. So As you know, most of the times when the market is going up, which is for us means that it's setting higher lows and it's setting, the 50-day moving average is above the 200-day moving average, for example. We have a list of 181 ETFs, for example, and whatever's moving up on that list, we're momentum buyers. We want to capture that momentum as it goes up, and we'll show you what's moving up now here in a moment too, which is kind of fascinating. And then whatever is falling and falls past the cut line, we're out of that, and then we move into those things that are moving up. And we have two different systems. One's kind of moves faster and quicker. We use those in the IRAs and what have you, just because we don't have to worry about taxes and reporting any transactions as far as that goes. And on the other side, we have a slower mechanism that moves slower for those taxable accounts. So we really don't want to sell something at a gain unless we really feel like we need to. Now, once we get below, like we have here, the 50-day moving average moves below, we switch over to a different system. Still have the list, but if we're in a red, we're out in that time frame, right? If we're in a yellow, the list is just restricted. So that 181, we're going to knock off everything that has a higher standard deviation than the market itself. Okay, so standard deviation is a way to measure, the risk and how much something moves. So we want things that move slower or equal to the market. All right, so we're just going to be a little bit more conservative. It might be in utilities, dividend-paying stocks.
Consumer staples.
Consumer staples would be a good example, exactly. And if it's green, we just got the whole list. It's just like any other time frame, right? So when you see those signals that come up, maybe you can show them, see what they look like here. When you see these signals come up, they are basically being used to, for the moment when the 50 days above, just as as interest, red. That's not too surprising, right?
Yeah.
I mean, things are struggling here recently, but when those signals have a much bigger impact for us as a trading concept when we are below, right? Because when the 50 days below and you're setting lower lows, your primary direction has changed. It's down.
Yeah.
Now, it might not stay down very long. Like what to say, when you look at this tariff issue, right, they can change their mind and the market could come right back.
Yep.
However, tariffs or bad decisions or layoffs or freezing government contracts, what if it causes a big recession, right? It's possible. So those things, even if they change their mind at some point, it might be changing it too late, and you could have, a downturn. Whoops. Like you see, you can take that signal thing off here. Like you see basically, in 2008. Now, I'm not saying we're going to end up with that type of downturn, but that's the difference. And I think it's really important to kind of understand what's going on. This is not right now a structural downturn. This is a decision downturn. Somebody deciding that they're doing something and the market doesn't like what they're deciding. Whether the market's right or not, 2018, those tariffs are still here, right? We just hit an all-time high not too long ago. And so I keep bringing that up. Now, those tariffs were $350 billion. The tariffs, at 25% on China, on Canada and Mexico, 20% on China is estimates about 1.5 trillion. Okay, much bigger difference as far as that goes, and that's per year. So, and of course, then you get the retaliatory tariffs, all kinds of stuff. That's where you get into trade war as far as that goes. So anyway, that right now as we speak, just so we can kind of update things, we had 25% tariffs on both Canada and Mexico, I don't know, for a few hours a day, whatever that worked out to. And then all of a sudden, now we have a month reprieve on everything that's part of the USMCA, I believe it is.
Yeah.
Which is the newer version of NAFTA. I remember NAFTA easier for some reason. Anyway, where we have no tariffs. We trade with Mexico and Canada. And so that's the problem is because the USMA is there, these companies like auto manufacturers, they're, optimizing their scenario. So like, I read an article about one piston that crosses the borders 6 times, right? Because different processes are being done in different places. And so that's where it really becomes a problem. These companies have already invested in this big infrastructure, and then all of a sudden you put 25% tariff, you're going to really, really damage
Yeah,
the car
especially
market.
because every time a border crosses,
Yep.
you're raising, you have to do another issue of tariff.
Another 25%. So yeah, that would be pretty devastating. So they actually, I mean, according to the interview, with Trump, they basically, the big car manufacturers, had a meeting with him and asked him to exclude, things that are in that agreement already, and he did for 30 days. So, this is going to be an ongoing issue as far as that goes. But again, remember that it is still a decision, all right? And at some point in time, the pain point gets high enough that decision might be to back off on the tariffs, quite drastically. So we'll see how that goes. I think the real issue will be, can they back off in time where before there's systematic damage done to the economy and what have you. So, we're already seeing things even before the tariffs were really in place, and even though they were kind of, only there for a few hours and then taken back, because it's affecting consumer behavior. People are pulling back. It's affecting corporate behavior. CEOs are saying, they don't know what to do right now, and they're just going to sit on their hands, right?
Yeah, when you don't know what to do, it's best to stay pat.
Yeah, and that's what's happening. Of course, when everybody starts to stay pat, you get unemployment, jumped up a little bit today from 4 to 4.1, and that doesn't really even include the federal job cuts, which are coming. So you're going to see unemployment go up more in the next reports. We did create 151,000 jobs in February, which is a pretty decent number, to be honest. So, we'll see how that goes. Does that start to deteriorate as companies feel like, hey, we should be, more careful until we see what's going to happen? The clarity is being asked for, right? And so, okay, so moving on. So this was from last week. This is the core PCE price index, which was reported last Friday, a week ago today. And you can see, I mean, actually, since May of last year, we've been in the 2.6 to 2.8 range. And so it's not coming down. It did come down a little bit to more closer to the bottom of that range at 2.65% for the month of January. Again, this is always looking back a whole month, but inflation's okay. I mean, based on this report, the fear is that it won't be okay, right? Mm-hmm. But you got to be really careful with the fear of, hey, this is going to cause this and this is going to cause that, because you don't know. I mean, first of all, we don't even know if we're going to have tariffs. We don't know how much the tariffs are going to be if we do have them, and we don't know how long they might last, right? All of which would need to be known to know what is going to be the impacts on, and even with that, I mean, you have a tariff. How much is coming out of corporate profits because they decide to eat some of that tariff? How much is being increased price, right? So that you and I pay for part of those tariffs. There usually is some kind of split, to be honest. They don't normally pass the full thing all the way along, but earnings drive the stock market, and if tariffs start to eat into earnings, that could be the issue. So, but we don't know. We don't even know if we have tariffs, right? The one that seems to be sticking around the most and doesn't seem to be talked about is the China tariffs, which, Apple makes their phones in China, for example. So you got 20% tariff. It could be an issue for Apple, which is why they announced a $100 billion investment into, manufacturing here in the U.S. Last week. So, we'll see how that plays. All right, so next. This is from the survey that's done. It's a sentiment survey. It's done every week. It's AAII, American Association of Individual Investors. Okay, this is a pretty fascinating piece. So for 226, so this is last Thursday, something very unique happened. 60.6%, or more than 60% of the people in the survey felt that the market would be lower 6 months from now. So that is an extreme reading. If you look at the very bottom there, that in the last 1 year, that's the highest it's been, which makes sense. You can download in a spreadsheet format all of the survey data. How many people were bullish on a percentage basis, neutral, how many people were, bearish, meaning they feel like the market's going to go down. And this survey started in July of 1987. Okay, there's only been 5 times where this survey has gotten below 60%. If you look at the arrows, right, there's one arrow there. There's 2 arrows right next to each other. That's the 2008 downturn. This is monthly data, right? So showing, you can see the 2000 downturn, and then it came back and fell again, turned into 2008. But even during the pandemic itself, didn't get to 60%, right? During the heavy markets dropping 35%, we're being invaded by a virus, we didn't get to 60%, right? We did get to 60% right at the bottom of 2022's downturn, which I thought was interesting, 60 or higher. And we just got that signal last week, right? So you know what the average rate of return is after that signal for the next 12 months?
No idea.
Positive 28%.
Oof.
So I went through and did the math on the different components within that spreadsheet. After each one of these signals, the average rate of return was positive 28% on average. Now, the first signal there in 2008 was actually not, it was negative. So it's not always positive. It's not 100%. It's not like the Zweig breadth thrust indicator, which is still sitting at 100%. And so anyway, we just had what would be a buy signal. Okay, now this is really strange to people, because now we're showing you people are scared. Yeah, and what happens though is that when it gets to the extremes, they're out of the market, and so then the only people that are left is that few people that are bullish. In that survey, I think it was like 25% or 27% that were still bullish. They start to control the market, and that is why you see, in these extreme bearish situations. I remember in October 27th, we were having a show, and we showed a sentiment indicator that was extremely bearish. And that day, the market turned around, and we took off. We were 9% up, almost 9% up in November of that year. Because one of the things, if you look at how this works, you get a few people, everybody, all the negative people are out. You get a few people that start to buy. It starts to run up the market. There are a lot of people shorting the market because they are shorting something because they feel like the market's going to continue to go down. All of a sudden, they start to panic because you have unlimited liability in a short, right? And so they start to buy back the stock, which you have to do to uncover your short, so to speak, which of course makes the market go up. And so you can get this pop, and then all of a sudden, all those people that were scared are now thinking, "Wow, man, I got to get back in there," and that's how you get a 9% month. So I think that's very interesting. Now, I'm going to show you an example just for the past month for some areas that are actually still working right now. And this is where we've been rotating a lot of our target holdings in at least our quick, our fast signal type accounts, which would be the IRA type accounts. So this is VTI. So VTI is the ticker symbol for the Vanguard Total Stock Market Index. Okay, this is most of, I think it's like 98% of the stocks here in the U.S. are in this one particular ETF, which we use as our measure of the market when we're analyzing how we're doing. So you can see in the last month, we actually hit our all-time high up there, and then we've kind of tumbled down since there. Today, right above Ethan's head there, we're seeing a little bit of a move, which is good. Now, let's look at VXUS as a comparison. Okay, so VXUS is the Vanguard Total International Stock Index. So this is a majority of the stocks outside the United States.
Yeah, you got your China, Japan, Europe, all your different countries, UK. So everyone has different little weightings. So
I believe there's 11,000 stocks in that. I can't remember for sure. I know the US one is in the mid to high 4,000s. But so VXUS has been going up in the same 1 month time frame. So the US VTI in 30 days is down 5.66%, just above Ethan's head there. And then VXUS is up 3.4%. So the rest of the world is doing okay. I mean, we're kind of creating our own little microcosm of pain here with the tariffs and different things along those lines. People are worried about what impact that might have here. Ultimately, long term, you'd have a hard time avoiding a big recession in any country. It usually becomes global. But at the moment, as a defensive measure, you can have more international exposure. That's the first time I've said that in a really long time, because usually the U.S. is doing much better than international. We're seeing the dollar fall, which helps U.S. investments. I mean, non-U.S. investments. Okay, now if you go one step further than that, this purple line, the ticker symbol there is VGK. Okay, that's the Vanguard Europe ETF, right? And so you can see that's doing even better. So Europe as a whole is doing better than the international as a whole, and certainly doing better than the U.S. as a whole, right? So that's up 7.14% in the last 30 days. That's a pretty good rate of return.
That's a 10-point swing from the
Yeah. Yeah, really. I mean, it's
10 point.
negative 5.6 to 7.1. Yeah, it's
10 plus swing.
yeah, that's a huge differential. So what's happened on our list, of course, is all of these international pieces are shooting to the top, and the pieces like we had, like cloud computing and whatever it might have been, are all falling past our cut line, and we've been rotating into these pieces pretty much daily for the last couple of weeks, 10 days at least. And so that's the advantage of having a list like that. It's the advantage of kind of looking at what's going on momentum-wise. And things might change as far as that goes. But at the moment, as long as we keep hammering away on tariffs and keep flipping and flopping and stuff, people are going to, the markets don't like uncertainty. And that's certainly what we have here. And so anyway, we lay people off. We try to hire them back. We've got government contracts that are frozen that are now having to be paid out in some cases. So it's very unclear as to what has actually transpired even in this short period of time. And so people are moving their money into other places away from the U.S. As far as that goes. And so we'll follow that trend, see how that goes, at least with our target pieces as far as that goes. Okay, so anyway, that's the summary. A lot going on as far as, the markets go. Really kind of fascinating to see how this ends up playing out. We're getting a lot of concerned clients, emails, different things along those lines. Ironically, this is just a normal downturn. If you look at that chart, for the year,
it's not too big.
This is the same as normal. I mean, the NASDAQ itself is down into correction territory, down to about 10%. But 2 years ago, the NASDAQ was up 40+%. Last year was up 30+%. I mean, you go up 40 and 30 in 2 years in a row, and then you're down 10. That could have happened no matter who was in office, no matter what was being said. That's like a normal thing. I think that's S&P 500 drops 10% once a year on average. 5% are really common. So, I mean, we're not even down 10 yet. So there is still, this aspect of understanding that we just had 2 great years. And, the momentum was very high, so it did take a while. It took a couple of months for it to start to actually break down. But this is not a big downturn at this point in time. Now, it could turn into one, right? I mean, always. Every 5% downturn could turn into a 10% downturn, which could turn into a 20%. Yeah, you don't know, right? Mm-hmm. And so you just kind of go along. You have your plan. You execute basically on that plan as those pieces start to develop, and let the market kind of tell you what it's seeing. So the market doesn't like the tariffs right now. That's for sure. Yeah. We just hit a first lower low. But anyway, that's what's happening, for this week. We are getting a bounce today. I don't know where we're at. Do we still hold that or not? But it's not
0.25% up.
0.25%. Okay, we were down like a 1% for a while, up nearly 1%. So it's the volatility daily is picking up, mainly because somebody says something, and the market jumps on that. The White House and the group that's running our government is really an attention focus point for the market, no doubt. All right. Well, thank you for listening to all that. Look forward to seeing what questions we have.
Should we be concerned with the economy as tariffs are implemented and trade wars start? The slowing down of the economy and how that affects everyone.
Yeah. Well, look at 2018. Okay. What happened? That's the last time we did tariffs. We did $350 billion. Did that affect the economy? No, not really. They had started lower rates because the economy started to slow down a little bit. Probably for the same reason it's going to slow down now. People are just pulling back. They're just a little nervous. And then once they stopped doing the tariffs thing, the market took back off again, and we actually had a really good 2019. What you have to be concerned with is 2 things in this case. Number one, what's the size? Mm-hmm. Right? Because it matters. I mean, how much in the way of tariffs? Is it another $300 billion? Maybe the market and the economy absorbs that, and it's not a really big deal. And secondly, how long do they go, right? And so that part we just have no idea.
Yeah,
That's
so
where it's tough.
the Tax Foundation did an article about kind of like the ramifications. They estimated what the ramifications of the 2018 and 19 tariffs imposed by Trump and retained by Biden,
Yeah.
and they said they reduced the long-term GDP by 0.2%,
Per
and
year?
or they just said point 0.2. It
Okay.
doesn't state what, but unemployment or they lost jobs by 142,000
Yeah,
roughly. They
that's right.
estimated lost.
And so it kind of depends, right? And so if you magnify that times 5,
Yeah.
right? If you have 1.5 trillion in tariffs instead of 300 and something billion, and if it keeps proportional, right, you could end up with a pretty big drag on GDP and a lot more job losses in total, right?
Yeah, and consumers will have less money if prices go up with that. And
Yes.
so if consumers have less money, there's less money to go around for everyone, essentially.
Right, exactly. And so that's where it starts to kind of snowball into things, because the other part of tariffs is, if they're putting tariffs on washing machines, well, washing machines aren't that well represented in the S&P 500.
Mhm.
Okay, so those companies that might have less earnings, but it might not matter because they're too small. How does this affect the Magnificent Seven?
Yeah.
And so in some cases it does. Like Amazon's selling product, to individual consumers. How much does it affect Microsoft? Maybe not as much.
NVIDIA would be.
Nvidia would be less impacted than the washing machine company until there's an overall downturn, and everybody gets wrapped up into that, right? You end up in a 2008 or 2000 type recessionary downturn. That's where the danger lies as far as that goes. However, just like you said, the 2018, there was some impact to jobs, there was some impact to GDP. We just set an all-time high that is significantly higher than we were back in 2018, just a few weeks ago. So how much impact did it really have on the market in total? Well, it had a short-term impact, that's for sure. I mean, that chart is, 19.6 down, came back fairly quickly, but still pretty painful. I remember talking to clients about it and what have you, as far as that goes. And but the difference here is the potential size differential. These are big tariffs, 25%. It's not 2.5%. That'd be a lot more reasonable. But 25 is a big, big number. And so I guess the concern is, who's right? I mean, there seems to be some discussions about, from all these different economists and what have you, about the impacts of tariffs historically. And then there's another group that thinks it's not going to have much of an impact at all, that it'll be revenue to the country. We can use that revenue to offset tax cuts. And, who knows in the end who's going to be right as far as that goes. There was a lot of consternation in 2018. And it did have some impact, but when we're talking about the stock market, it didn't have a really big impact long term, that's for sure. But again, what's the size? How much money are we talking about here? And I don't think we're done. We're going to be dealing with Europe. We're going to be dealing with Australia, New Zealand. I mean, they just go country by country. This is going to be a whole thing of... Unfortunately, they got to come up with an emergency, right? So the emergency is fentanyl coming into the country, which apparently isn't that big of an emergency on the Canadian border. But nonetheless, in order for the president to be able to do a tariff, it has to be under an emergency situation. So they make up emergencies, right?
Mm-hmm.
So Congress could step in and take the authority back and wipe out all the tariffs tomorrow. So there is a backdrop there. I don't see that happening unless there was a lot of pain, because people are going to basically not want to go against the White House in this, but you never know. If, we're down enough, maybe they do something about it. So anyway, it's a great question. It's a question that doesn't have a great answer right now, just because we don't know.
It's such early days, and
Right.
the policy's changing so rapidly.
Yeah, exactly. I mean, the market is responding negatively to it, so pay attention to what the market's saying. But again, look back to 2018; it responded negatively, and it came right back. So
It took a while for the
Yeah.
course to be changed too.
yes, that's right, exactly. All right, what's our next question?
Should I take my Social Security early? I'm still not full retirement age, but I have access to benefits, and I'm just worried that people aren't taking benefits will get their benefits cut.
Yeah, so no matter which administration is in charge, Social Security the trust that they put the excess money into is running out of money by 2033 to 2036, depending on kind of who you listen to and what time frame that is and what have you. And so that's not very far off, right? And what would happen is there'd be about a 20 to 25% drop in the amount that could be paid out from Social Security. The projections show that it would not drop past that forever, pretty much for 75 years.
Yeah.
So how do you keep it at 100% right now? Well, they're going to have to change Social Security the way it works. So Reagan and Tip O'Neill got together and they kind of hammered out, essentially what we're dealing with now. They changed the retirement age was one of the big ones. So now, like my father could get full retirement benefits at age 65. I could get mine now at 67, right? So that could move, 68, 69. However, everything I've read so far says they're only looking at people who do not qualify for Social Security. So if you're 62 or older, even if you're not taking Social Security, for everything I've read, it doesn't matter whether you're taking it or not. It just matters that you are qualified. They're trying not to change, which is the right thing to do, by the way, because those 62 and older, they're already, all their plans and everything are based around, the concepts of what.
You can't make a change very quickly for that.
No, not for that group. Now, maybe if you're not qualified for Social Security, which this question, makes this question, a different question. But nonetheless, I expect I'm 60, I'm pretty close. I don't know how much it would change, but it might change for you more.
Yeah.
Right? Your full retirement age might not be 67.
Yeah, it's probably going to be, maybe it could be even in the 70s for all I know.
Well, I doubt they go past 70. I will say, because there's lots of ways that you can save Social Security. You can reduce or eliminate the cost of living increase, right? Which they already did. They made a new basket for seniors, but basically they cut it. Or you can increase the retirement age, right? So I think 69 is probably more likely for you than something past 70, but. And lastly, there's a cap. So I think it's 183,000. Once you've made 183,000, you don't have to put more money into Social Security.
Yeah.
So if you raise that cap, if you made a no cap, Social Security is gushing with money. Believe me. But this is a Republican regime. I do not see that part coming into play.
You have to remember Social Security is 21% of expenditures for the U.S.
Yeah.
Spend.
Right.
So it's a major cost.
Yeah, exactly. So that I think there will be changes to Social Security. For everything we've read so far, say that if you qualify for Social Security, it won't be affected as far as that goes. Am I affected at 60? Or I don't know. That's going to be interesting. But they can't go too far back in age, only because they have a problem coming up in a very short period of time here in 2033, 2036. So it's going to be interesting to see how they fix it. There's other ways to fix it and what have you, too. One of the things they're talking about is taking away the taxes on Social Security, which actually makes it fall apart faster if there isn't some other way of bringing in money. There's a lot of discussions. There's always a discussion about privatizing Social Security or making it so that you can invest like a 401k. Put money in the market and these different things. So, we'll see what happens, but it's a good question. All right, what's our next question?
So what are your thoughts on the strategic Bitcoin reserve as well as a separate digital asset stockpile?
Yeah, so that's actually today. They're having a news conference today, I guess 1:30 DC time, kind of a executive order establishing a reserve for Bitcoin. They were talking about, well, how do we, this is on Bloomberg Radio, even just driving in this morning, they were talking about, how does the U.S. get Bitcoin?
Yeah, if you're buying off the market, you're going to inflate the price.
That's right. And so one of the things they were talking about, they've been debating about, is maybe people can pay their taxes in Bitcoin. If you have these tariffs, they could be paid in Bitcoin. And so that would allow the U.S. to kind of accumulate, some of these cryptocurrencies, and they've talked about other cryptocurrencies too, but I'll use Bitcoin as a...
Yeah, and supposedly right now the U.S. government owns around 200,000 Bitcoins. And so that's about 17 billion-ish.
Yeah.
So they do have some right now.
Right. Obviously, they're talking about a much bigger amount here in the end.
It's interesting because a lot of times when you think about a strategic reserve, you think about it for a use case, right? We have the petrol reserve because if there's an oil shortage, we can just use our reserve to kind of cover that.
Right.
And so, what is the use case for having a digital currency reserve?
Well, if you're selling meme coins, it's the use case is that it would it probably enhance the overall thought process of having more people buy digital currencies and meme coins and what have you. So there's a vested interest, unfortunately, by the White House probably, as we saw with those meme coins that came out just before the inauguration. So past that, I think it's really interesting. I think the problem with that I have is that even if you don't have any, like for example, 2008 was a huge downturn.
Mm-hmm.
They were selling what was called, setting up subprime mortgages. Somebody who can't afford it. That's essentially what it is. And I remember thinking to myself, well, we don't have any subprime mortgages anywhere in our portfolio, none. And yet the market still dropped 57%, and so it affected everybody. And so that's where we always have to be careful about these different asset things that are out there and what's happening. Unfortunately, most of the times the big downturns are from something we're not talking about. Is maybe not Bitcoin, but the thought process of Bitcoin is that you have to have somebody else that wants to buy it at that higher price, and so new people coming in start to bring that price up, right? When do new people stop coming in? And that's where the price really can drop and what have you too. So it is just one of these things where, putting it into government approval, essentially by setting up a reserve, you're going to have more new people coming in. It could be pretty good for the cryptocurrency itself. But just, how does that play out when we have trillions of dollars worth or some big number, whatever that might be, as a reserve? So, I think it's going to be interesting. And the use case has always been a problem. The use case so far is just buy it, hope somebody else buys it at a higher price, right? That's it. And there's no, using it for, I guess you might be able to pay your tariffs or your taxes with it, if you had some. So that, if it went up, that'd be nice, right? I mean, so it's a good question. I don't know, the overall impact. And apparently, according to the Bloomberg radio interviews that I was hearing this morning, it does need congressional approval to get through. So, we'll see what happens there. So, all right. I think we have time for one more.
Can you explain the traffic signals? Like, how do you come towards them, and how does that work?
Yeah. So, here's an example, and aren't the current signals. You can maybe flash those up there if you want, just so we can see. But yeah, there we go. So that's current signal for stock is fast and slow is both red. Bond is what red, yellow, green. All right. So what happens with the signals? First of all, if we're above if the 50-day moving average is above the 200-day moving average, we're not paying that much attention to it. We keep them going because I think they're interesting. There's some value to them. We have a whole, I'll call it, proprietary system on how we figure out what the signal should be. All right. And we have two different ones because we manage two different types of pools of money. So first of all, money that's in an IRA or 401k or 403b or 457 or any of those types of Roth IRA, whatever it is, you can make more transactions, especially if the transactions are, no commission. You can make more transactions and react quicker to those without any real issues, because you don't have to put all those transactions down in your tax return. You don't have to, deal with any taxable nature of money that you made type of thing. And so, however, on the accounts that are outside of those, what we call the taxable account. So that could be an individual account, a joint account, a community property account, a transfer on death account, a trust account, right? Yep. Lots of registration names, but it basically just means that every time there's a dividend or interest paid or any transactions are made, all of those end up on your tax return, right? And so you want that to be slower. You don't want to end up with a tax return that's multiple pages with all these changes.
Yeah, even if a stock's underperforming the market, you don't. If it's underperforming by only slightly a little bit, then you don't really want to take that tax burden on.
That's right. I mean, you might lose, 10 to 30% of your gain, and you're moving out, and you don't, and all of a sudden it's a false signal, and you're going back. So you want it to be more sustained downturn in that particular category which we've seen like in the bond market, for example, some sustained downturns. So anyway, that's where. So right now, it's red. If we were in a 200 moving average was above the 50, so the 50 had fallen through in that death cross, we would be in T-bills for most of our assets that we could, outside of those big gain pieces that we have. We have people that have, $1 million gains in their S&P 500 ETF. We're not going to take $1 million gain for somebody, but and so I think that's where we are, but we're not there right now. So what we're seeing is a move more towards consumer staples, Europe, international investing, those type of things. T-bills are starting to move up on the stock signal list. On our bond signals, we are currently kind of in a mixture. We're still in T-bills for most of our slow-moving pieces, and our fast-moving pieces are more invested in some of the longer-term treasuries as far as that goes. So anyway, that's what the traffic signals mean. They mean something to us, more so when we've had that death cross, but still interesting. They are somewhat predictive as far as that goes, and so we'll see how this goes. All right. So all right, that's it for us today. We just finished up. Thank you so much. Spent some pretty good time on that summary for the market and didn't get to some of the questions that we actually have. We'll try to cover those next time. But we missed the last show. I wanted to make sure I did a thorough review of what the market's doing. And it certainly is the thing I'm getting the most questions about in our client meetings. People are quite concerned about where this could go. And again, unfortunately, this isn't just a normal, 5, 6, 7% downturn. It's combined with all of this scary news.
The uncertainty of, and not the predictive nature,
Right.
when you're not able to make any predictions or understand the outcomes.
Right.
Adds to the fear of the unknown.
Yeah, I think when it was April of last year, we dropped 5%. I didn't get any emails and people worrying. This time we dropped 5%. I got people, that are quite worried about what's happening because again, it's combined with that uncertainty and the things that are being said, in total on all sides. So, okay, well, thank you very much for coming today. Again, if you have questions, feel free to send them in during the week, and we can try to answer them next week. So ask Tom at Talk Money with Tom. You can send them there. And again, if you want to continue to, increase your education, go to our channel, subscribe to the channel, hit the bell button for when we put out new content as far as that goes. And we'll try to keep, producing. I think we got a couple thousand videos on there now. So that's a good resource. Learn about retirement to make your retirement better, in my opinion. And then lastly, if you'd like to meet with us, please feel free. You go to our website. There's a link here on this channel, and there's a button looks just like that, book appointment button in the corner of our website, and you can pick a 30-minute time to meet with Ethan and I. So thank you, everybody, for coming today. I really appreciate it. I look forward to seeing you next week.